Hey, it can be real easy to get a little lost and confused on the different loan programs that are available, especially if you're buying your first home. So I thought I'd just take a little time just to give you some generalities of the different loan programs that are out there to kind of help you on your journey if you've got some questions. So let's start with the first one. It's probably the one that you hear of the most often. It's called conventional loans. So conventional loans are really geared for people that have some established credit, maybe a little higher credit scores, and typically comes with a little bit more down payment. Now you can get into a conventional loan with 3% down in some cases with some income limits, but typically you're going to see 5% or more down on a conventional loan because it's going to be typically a little bit more of an affluent buyer. With that being said, 20% down will allow you to avoid the nasty word mortgage insurance throughout the entire time of the loan. Anything less than 20%, you will have mortgage insurance, and then your credit score will be a prominent part of that on how much mortgage insurance you'd pay on a monthly basis. And there are some options with the mortgage insurance. Depending on the loan, you may be able to do an upfront mortgage insurance. There's different options on doing it. You can do it monthly, you can do it up front, you can do a split. You'll have to talk with your mortgage lender to get more information on that. The second mortgage program that's out there is what also people are familiar with. It's called FHA. The FHA loan is a Federal Housing Administration loan. It's insured by the government. It only requires a 3.5% down payment, but it does include mortgage insurance and includes mortgage insurance for the life of the loan. It also includes an upfront mortgage insurance fee that you can finance into the loan, but it does include some additional costs because you are financing that in. And then you do have that mortgage insurance, but it is a viable option for a lot of folks because it's got some flexibility in the underwriting guidelines and with the credit guidelines and those types of things. So it can be a good option for a lot of people. And then we have a VA loan. A VA loan is really geared for veterans, active military, and in some cases for spouses of veterans as well. It does not require a down payment, so zero cash down. It does not include any mortgage insurance. And then in many cases, it's going to have what they call a funding fee. A VA funding fee is essentially a cost in lieu of mortgage insurance. And that's once again can be financed right into the loan. Now, depending on the veteran status, if they've received a certain amount of disability income or have some disability claims through the VA, you can get that funding fee waived, or they would be exempt from the funding fee. And so then at that point, it really is a zero money down, zero mortgage insurance type of loan. And it's about the best terms that you can possibly get out there. And then last but not least, one that's not as common, but certainly a good option for those that are looking to buy a property outside of the metro area. The metro area, you'd probably have to look on a map. If you go out and you start searching for rural development or USDA loans is where you're probably going to find this on the website. If you go out and look at USDA, there is an eligibility map. So if you've got a specific property that you want to look at, you want to determine if it would qualify for rural development or a USDA loan, you simply have to plug in the address and it will tell you whether it's eligible or not. Now, with a rural development loan, it does have a mortgage insurance, which is less than what you typically see with mortgage insurance, but it also does come with, once again, a funding fee. And so it does not require a down payment, but you do have some of these little extra costs that are associated with it. But also, once again, a great option to keep money in your pocket and allow you to buy a home. So I hope this helps. The key with all of this is to have some strategy, and your mortgage lender should be able to present the options to you, tell you what you're eligible for and what you're not eligible for, and then break that down so you can make a smart and educated decision when it comes time to pick which loan program you want to use. The strategy is key because it can save you thousands over the life of the mortgage, or it can cost you every single month. So make sure that you're familiar with these loan programs. Make a decision based off of the information provided to you. And I hope you enjoy your home ownership journey.